David, the other side of the equation, of course, is when to sell the stocks. How does the CANSLIM formula and the daily graph research help in that decision?
When I buy a stock, even before I buy it, I set a point of where I'm going to be out of that stock. I set a 7% stop. And it's a point where I say, okay, I've made a mistake. The stock has gone down 7%. I should get out of it and move on to another investment, another stock. The reason why you set 7% is that you try to keep your losses as small as possible. And I might have a number of very, very small losses. But when I hit a big stock, I usually make a lot of very good money, a lot of big money on that. And it makes up for all these very small mistakes. Because the main objective, I think, in any investment is when you're wrong, you want to lose the least possible amount of money. You never want your losses to become 25%, 50%, and hold on and rationalize. Another reason why I set 7% is because it's so easy to rationalize, to say, well, the market's down a little bit, or I know the company's going to come out with a big earnings report, and it drops another 5 or 10%, and then you're down 15%. And then you can come up and say, well, I know the president of the company, and he said that they're coming out with this product. And you can come up with 1,000 excuses of why you should continue to hold on to that stock. And if it continues to drop and it goes down 50%, well, it's got to double just to get your money back. So, and that's very hard to find a stock that doubles. So you try to cut it off as quickly as possible.
So we're talking discipline again.
Yeah, and you try to stick to it as well as you can.
What about discipline at the other end, when you want to take your profits, when you want to sell, and there may be the enticement to hold the stock a little longer? What's your high-end cutoff?
When I buy a stock, I never set an objective of how far it's going to go. If I buy a stock at 20, it moves to 30, I usually have what's called a trailing stop. I move up a point of where I'm going to sell as the stock moves higher. And a good way of imagining how a stock moves is sort of in a stair-step fashion. Stocks don't usually move straight up and come straight down. They usually move up and they go sideways, move up, go sideways, just like a staircase. And as the stock moves up, and then it starts going sideways, it builds a base for at least 6 to 8 weeks, I move up my stop point right below the bottom of that stair. As the stock starts higher again, starts building a new stair, well, I move up that stop point right behind it. I stay with the stock as long as that staircase continues to be built. Once it's broken, once a stair is being built and then breaks down, I go out of the stock, I sell the stock. And you can see those patterns developing in the daily graphs. In many cases, they're very clear. And I use the graphs to help me with the timing on the sell. So it's a combination of watching the stock, looking at the graph to give me a point of where I get out. Because you want to protect those profits that you've made. When I was giving a seminar in Columbus, Ohio, I had a woman come up to me after the seminar was over, and she said, gosh, I wish I had learned that principle of moving up a stop point to protect your profit a few years ago. Because she had a company called TCBY Yogurt that she invested in. Stock went up. She made, at one point, about $950,000. She made almost $1 million in that stock. And then it started to drop, and she didn't sell. It continued to drop. She didn't sell. Stock came all the way back down to the same point where she bought it. She lost her entire profit of $950,000. So that's something you want to avoid. You want to hold on to those big gains, and that's one way of doing it.
Your profits have been incredible. Your track record very impressive. Is this the method, or is there any more to it that secures that kind of profit?
That's basically it. There are a few other things I incorporate by using the daily graphs. I look at a 50-day moving average. That helps me with my timing. I look at the general market. If the overall market is really starting to fall, sooner or later as you go into a bear market, they usually get all the stocks. And I might start cutting back on a position in a stock.
Once an investor is adept at using the CANSLIM profile or formula, if you will, and using the daily graph information, some other factors here. What about diversification of their portfolio so that they don't have all their eggs in one basket? How do they apply the formula and still be diversified?
A lot of people think diversification is the key in the stock market, that you should own 20 stocks. I think diversification is valuable when you're looking at all your financial assets. You should have so much in cash, so much in bonds, so much in stocks, and so much in real estate. I think diversification there is fine. But when you're looking at the stock market, I think you should concentrate as best as possible into about 4 or 5 stocks. When you have 20, that's too many to look for. It's too many to keep an eye on and watch and see how well they're doing. When you have 20, 10 will go up, 10 will go on down. You'll never make any progress. If you have 4 or 5 stocks, you can see how the company is doing, how the products are performing out in the marketplace. You can give the companies a call, read their annual reports, and watch them very closely on a daily basis. It only takes a few minutes to look up 4 or 5 stocks. So you should concentrate. When one is not doing well, and you could spot it very quickly because you're watching it so closely, well, you kick that stock out and you move into another one, or you move more money into your better performing stocks. When I get down to it, when a bull market is starting, usually you don't know exactly which stock is going to be the big leader. I buy maybe 5, 6, 7 stocks, and within a few weeks or a matter of a few months at the most, I narrow it down into 4 or 5 stocks. Then I narrow that down even farther, and I put a majority of my money into maybe 1 or 2 stocks, because you want to narrow down, you want to zero in on the strongest few companies in the market. And if you can get those top 2 and they make fantastic moves, well, that's where you can really make a lot of money. So I've made my money in concentrating on the best stocks in the market.
If the listener is going to do exactly that with just a few selected stocks and using the system, what kind of a broker should they select to make the transactions for them?
If you're doing your own research in the market, you're using the daily graphs, the Investor's Daily, and you've got a methodology like this CANSLIM, then you could probably use a discount broker. Now, if you don't have as much time, well, then you should turn to a retail broker. Find somebody who does some work on the side that doesn't just use their firm's recommendations, because you'll find the most successful brokers are the ones that come up with their own ideas. I'd also find a broker who's had a number of years of experience, at least 4 or 5 years, who's gone through a few market cycles. And to find a good broker, I'd pose the question to him of what books has he read? Has he read O'Neill's book? Has he read a few others that are very good?
Does he read Investor's Daily?
Yeah, does he get Investor's Daily? How does he come up with his ideas? How does he select stocks? Does he have other clients who've made some very good money? Because in all professions, you only have maybe the top 2, 3, 4% that are very, very good. And you should take some time to really find out who is making the money for their clients.
So you've got to have the same methodology to have the right chemistry with the broker.
Right, and to get along with them personally is very important.
One thing you didn't mention in all of this methodology and in the CANSLIM formula is the price-to-earnings ratio. The PE has always been a big consideration in selecting stocks. Where does that come into play here?
When we did a study on the greatest winning stocks, this greatest winners that O'Neill put together, we found that the average PE before the stock made a move was around 18 times. So you're not looking at companies with very, very low PEs under 10 times. A majority of them were trading at about the market average. And to find the market average, you look at the S&P and you see what the average PE ratio is on the S&P 500. Most of these stocks, before they made their move, traded similar to the S&P, or maybe 1 to 1.5 times the S&P 500. So I wouldn't eliminate high PE ratio stocks, because some of the greatest winners have started at 30, 40, 50 times earnings. A company that I invested in a few years ago, Home Shopping Network, I think was trading at over 100 times earnings. Genentech is another example of a stock that was 200 times earnings before it made a very substantial move. The only thing I caution you on buying very high PE ratio stocks is that your timing has to be very good. You have to buy them right when the new bull market is starting, and you have to be selling them right as the top is occurring. Your timing just has to be a little bit better, because when fund managers buy a high PE ratio stock, if the market starts getting into trouble, those are the first stocks they're going to start unloading, because those companies are being bought based on earnings that are going to be coming in maybe a year or 2 down the road. And if we start getting into a slowdown in an economy, maybe those earnings won't come through. So don't put a strict parameter on where you should be buying your stocks. You shouldn't say, well, I've got to buy them under 10 times earnings or under 15 times earnings. Don't set any parameters. Just look at the stock. If it's got the CANSLIM characteristics, I wouldn't put that much weight into the PE ratio.
Using the CANSLIM formula and the daily graphs and all of your research, you have done exceptionally well and have an incredible track record. But then again, you're an exceptional investor. What about the average person? Can they use this formula as effectively as you've used it?
I think they can. It takes time. When I first found out about this method and started using it and employing it, it took me a year and a half, 2 years to really get down to know exactly when to buy stocks. And it's a lot of it is trial and error. You make some mistakes, you lose some money, you make some money, but you should be learning from each one of those mistakes. But if they incorporate this methodology, the CANSLIM, if they use the Investors Daily, if they use the graphs, I think they can vastly improve probably the performance they're having right now, by not using any methodology at all. So the average investor can do it. You have to put in some time. It doesn't take 10 minutes. It doesn't take 30 minutes. It takes at least a couple hours a week, if not 3 or 4 hours a week. But if you want to make money in the market, if you want to be successful in anything, you really got to put in a lot of time. So if they've got the time, they can do it. If not, then maybe they can search out a broker who can help them out.
Have you had any feedback, David, from people who have used the system and it's been effective for them?
Yes, especially on the 7% loss rule. One gentleman gave me a call after I did a seminar up in Portland. He wasn't even at the seminar. Someone recorded it for him, and he listened to the tape. And he gave me a call. He said, there was one point that really stuck in my mind that has helped me out, and that's that 7% stop loss rule. Because he bought a stock called Gap Stores. It was about, I think, 76, 77 at the time, and he put in his 7% stop. Well, the stock started down, and he got stopped out around 72 or so. I think he had 1,000 shares. He lost about $5,000. But what happened is that by the time he had called me about 3 weeks after he had been stopped out, the stock had fallen from about $72 a share down to $18 a share. So he saved about $52,000 if he had not employed that stop. Those are the things you want to avoid, those big losses in the market. So it doesn't matter if you take a small loss. Well, you still have a majority of your capital to turn around and then go back and invest into another stock situation. So try to stick to that 7% loss rule.
We talked about the patience, the discipline that's necessary, certainly the formula, the CANSLIM formula, and the research from Investors Daily. Any other tips or advice you can give our listeners?
Every time you invest in the market, every time you buy a stock, you should learn from that investment. When I buy a stock, as I'm buying it, I write down on a piece of paper, or I get the chart, I get the daily graph, I cut it out, and I write down why I made that investment, what characteristics that stock had, what was the market doing. You could also tear off an S&P sheet, ask your broker for some information on the company. And cut it out and put it in a notebook and write down your comments, your feelings, and what the market was doing at that time. Then after you sell the stock, you should go back and see why you made money, why you lost money. You should study, especially your mistakes, so you don't repeat those mistakes again. Because I like to refer to investing in the stock market as going to the University of Wall Street. Every time you buy a stock, and especially every time you lose, you're paying a tuition to the market. But when you're paying that tuition, you should be learning a valuable lesson. And after you've paid maybe years of tuition, then you're ready to graduate because you've learned from all the mistakes that you've made, and you're ready to cut out those mistakes and make more money in the profitable situations. So learn from every investment that you make.
We're running out of time here. Are there any other key points we should pass along to the investors to be considered?
Yeah, a few things. Low-price stocks. I would avoid stocks under $10 a share. Most institutions can't buy them that low. Also, we found that the majority of the best stocks began their major moves between $15 a share and $30 a share. That's the area I'd be looking at. I would never take any tips or rumors because usually they're from poor sources. You make your best decisions when they're your own decisions, and you have no one else to blame and no one else to rationalize with. So just come up with your own ideas. Don't listen to the tips or rumors or things like that. One last thing, market orders I think is very important. A lot of people think, well, I should place an order a quarter below the market. I'll save 25 cents on a share. But if you think a stock's going to make a major move, it's going to go from 30 to 60, a quarter of a point isn't going to make any difference. It's the same thing on the sell side. If you think the stock is going to fall and it's going to make a substantial drop, sell it, get out. Don't ask any questions. Because in the long run, you'll probably do a lot better. I learned this lesson a valuable way. I was trying to buy a stock called Techstone back in 1982. Stock was trading at 15. I put in the order at about 14 3/4. Stock never pulled back to 14 3/4. The next day it jumped a 1.5. At that point, I started thinking, stock is too high, I can't buy it. I could have bought it at 15, now it's at 16.5. Stock continued to move, I never bought it. It went from $15 to $45 a share. I missed a triple because I was too greedy. I didn't want to pay an extra quarter of a point. But if you know you've got a good company, just go ahead and place a market order.
Thank you, David. You've given our listeners a lot of helpful new ideas on investing in the market. Before we sign off, I want to tell our listeners how they can get a special introductory subscription to Daily Graphs. The folks at Daily Graphs have set up a toll-free 800 hotline number for new subscribers to call anytime, day or night. It's 1-800-423-1171. And when you call, you'll get a 10-week trial subscription to the New York Stock Exchange edition of Daily Graphs for only $48. Or you can get 10 weeks of the combined Amex and OTC Stocks edition for $48. Or better still, you can try both editions of Daily Graphs, New York, Amex, and OTC Stocks for 10 weeks for just $89. Be sure to have your credit card ready when you call. That number again, 1-800-423-1171. Don't wait too long to call. They tell me that this is a limited time offer and may not be repeated. For Investors Daily, this is John Darren. Thank you for listening to Investing to Win with our special guest, David Ryan.